Yes, we can proceed.
Good afternoon, ladies and gentlemen, and welcome to the third and the concluding day of third edition of BBF-IFIE World Investor Week, India Investor Show 2022. I'm Anurag Bansal, and today I have with me the most heard voice of Indian capital market, none other than Nitin Kamath, founder and CEO, Zerodha. How are you, Nitin?
Good, Anurag. Thanks for having me on this.
So audience, give me a couple of minutes to introduce Nitin. I know it will be like showing light to the sun, but that is one of the tasks that is assigned to me. So here is the introduction. Nitin bootstrapped and founded Zerodha in 2010 to overcome the hurdles he faced during his decade-long stint as trader. Over the last decade, Zerodha has changed the landscape of Indian broking industry, with more than 10 million customers contributing to over 15% of the exchange retail trading volumes. Zerodha is largest retail brokerage in India today. A tech-first company now, Zerodha offers innovative trading and investment solutions that appeal to a wide range of audience in a bid to reach those sections of society that have stayed away from the capital markets so far. Nitin also started Rainmatter, an R&D fintech incubator and fund that has partnered with some of the best investment tech startups in India. Rainmatter is focusing on creating an ecosystem for spurring innovation in the financial technology industry. Most recently, Nitin has also set up the Rainmatter Climate Foundation, an Indian climate fund providing funding to startups and grassroots organizations working on solutions to mitigate climate change. Outside of work, Nitin enjoys spending time with his family, playing guitar, poker, basketball, and swimming. And I am happy to see that the topic assigned to you, a young investor's path to financial freedom, perhaps is most suitable to you. It will be great listening to you on the topic. Stage is yours, Nitin.
Yes. Yeah. Thanks, Anurag, and thanks BBF for having me on this. Yeah, I mean, I guess, I'll talk for a bit, and then Anurag, we can maybe do some Q&A after this, right? So I started trading and investing quite early. I started trading when I was 17, and there were kind of a lot of ups and downs. I mean, generally it's been more up than down in the last 5-6 years. Touch wood, but I'm usually, always getting up every day thinking, when does the next bit of volatility hit my life? So yeah, but generally I think an interesting thing, like not an interesting thing, I think it's actually one of those things most youngsters today don't think about, right? Is that what's happening right now, across the world is the average age expectancy, I mean, in the sense, thanks to the medical progress, we are all living much longer. Right? I think, like my generation of people will probably live up to on an average of 80 plus years old. Maybe the younger generation who are in their 20s will probably end up living 100 years and 100 years and over, right? Because of so much of medical progress. You don't know what's going to be there in the next 20, 30 years. Maybe, we will eventually have, something that can keep us alive forever, right? Now, the problem here is that the retirement age is kind of reducing, right? As in, so retirement that used to happen at 60, 65 years. Now, if you look at current generation, by the time you're 50, 55, you're already kind of hitting retirement because your skills that you've developed over your life isn't as much of use if you're not quickly adapting yourself, right? So a lot of people are becoming, are kind of retiring early, are going to live longer, right? So, and here's a big cash flow problem, right? Which is, if people were to retire at 55 and they're going to live up to 75, 80 years of age, how do you fund 1/3 of your life without, if you haven't saved enough, right? So I think it's very pertinent that every youngster out there, like a person just getting out of the college, ask this question to yourself, right? One thing you can do, as a youngster is constantly keep upping your skill set, so you remain relevant, right? So your retirement then is not 55, it's maybe 65, right? Because there are people who are constantly improving their skills and they don't get to a point and say, what, I've learned whatever I had to learn, right? In which case they can remain relevant for a longer period of time. So one way, is to fix for this problem is to constantly be curious and keep learning. The other way is to just start saving as early as possible, right? As in, I think from the first paycheck, you need to start allocating funds towards your retirement. Like, where do you invest is a secondary thing. I mean, does it come to stock market? Does it go to fixed deposit? Where is the secondary thing? But starting investing and saving and investing is really by far the most important thing I think every youngster should think about, and think about quite early, because every year you lose in terms of saving, early on in your life, the impact eventually is going to be significantly larger, right? Because what you save between, say, 21 to 22, by the time you're 55, that saving would have compounded for 30 plus years, right? If you don't save it for 21 to 22 and say you start saving at 25 to 26, you've lost 4 years, right? So you're lost 4 years compounded over 30 years kind of a return for your retirement of sorts. So I think the first thing everyone should think about, is just to start saving as early as possible. It doesn't matter how much money you make, right? A lot of people say, think that if I made a little more money every month, I will save, right? There is no little more. I've run, as in there is nothing. You are rich when you have enough, right? If you don't have enough, you'll never feel rich, or you'll never feel enough, right? So I think the right way to look at this is that 10 to 15% of your income every month, right from the first month, start saving it. Now, as a stockbroker, I have an incentive to say that you should probably start saving in the stock market. Maybe directly invest, or maybe do it through through mutual funds to maybe do it in the right way. But I think, personally, I think the right stepping stone is fixed income, right? The first and most important thing is to get into the habit of saving. Right? Now, the problem of investing into mutual funds is that, when you start investing, maybe you hit a volatile period in the markets where whatever you save doesn't show you returns. Now, the problem with most people is that as soon, their initial taste, or initial experience is what determines what happens longer term, right? So if you say the first year you came and invested in mutual funds, and if you saw a drawdown, you might decide to start not do mutual funds for the next 15 years of your life, right? So I usually, when I talk to youngsters, I say is the first most important thing is to start a habit of savings and investing. Where you save, be it at the safest place possible. So when you're making that habit, you ensure that you don't stop that habit for because of market reasons, right? So if you could start saving in a bank fixed deposit, right, the next best thing you can do is pick up fixed income instruments, right? And really the stepping stone for equity market should be investing through mutual funds, and through SIPs. Direct stock investing is a very hard thing to do. Not everyone can do it well, and like one of the most important things for an investor is to diversify. Now, diversification becomes very easy very hard at an individual level. If you have only 10,000 rupees with you, how do you create a diversified portfolio of stocks, right? It becomes really hard. And the reason you invest in a mutual fund is because you get the benefit of diversification, right? So with 10,000 rupees, you will have access to 10 different sectors, 40 different stocks, which will be impossible for an investor to build the diversification with only like 50,000, 1 lakh rupees in the, even if there's 50,000, 1 lakh rupees, right? So now you start doing mutual funds, start tracking markets and etc. And if you find an interest in a certain bunch of sectors, like I personally, there are a few sectors that I've been tracking for the last 15, 20 years, right? Because I have interest in that sector, So for example, if I'm an architect, if say one of you is an architect, and you are, in your business, you get to interact with, companies that makes hardware or, or some, ancillary to your business, say maybe cement or maybe whatever, right? So you get to track some of these industry flows. So, and if you start feeling like, like a little more curious about what goes behind the industry and, what are the companies, who are the companies who are doing well, why are they doing well? I think maybe that's a good way to start investing in the stocks, right? If you find a sector that's of interest to you, and then you start tracking a few companies in there. And then if you find an opportunity that, you find an undervalued or, like an opportunity to start investing, maybe investing in stocks should be like that. But here's the thing, like most, if you're not a curious person, if you're not a person who has no curiosity towards companies and sectors and economy and etc., the best bet is really mutual funds. I mean, I don't think anyone should be investing in stocks because of a stock tip, right? Just because your friend said, buy this stock, it'll do well. That tip is almost like the Chekroview types, you're getting in, but you don't know when to get out, right? As in, a company which is good today may not be good tomorrow, right? So the guy who gave you a tip, most of the times unlikely to tell you when to get out, right? So individual stock investing is a high risk kind of a thing. So for youngsters who are looking at at all of this, I think the most important thing is to start saving as early as possible, and the second most important thing is to kind of make it a habit, so you don't stop it anytime in between, right? Because every year you stop can hurt you quite bad. The third thing is, that whatever is the saving that you contribute from your salary or whatever, don't keep it at a fixed amount, right? As in, assuming, I started my career at 30,000 rupees salary, and I decided to say, save 5,000 rupees a month, right? At 15%. Now my salary after 4 years is 50,000 rupees, right? What I've seen with most people is that the amount of saving still is at 5,000 rupees, right? So as your income increases, how much you save also has to keep increasing, right? So if you're doing SIPs or whatever, have a step up kind of a thing in mind, that every year, whatever salary increase you get, you automatically come and increase your savings amount by that much as well, right? Because otherwise, like we know, we live in a high inflationary kind of an environment. If your savings, how much you're saving doesn't go up with time, whatever eventual savings will not be enough of sorts, right? And the last thing is, when we talk about finance, and savings, etc., the other most important angle here is your health, right? As in, a lot of people miss getting insured, right? So I think the first step, when you start in this whole journey of savings and investing is to also realize that this health, is one of those events that can potentially cause a lot of drawdown in your savings, right? I've seen friends, who've saved for 10, 20 years, and one health incident is all that took to take away all that saving because they were not insured. And your insurance costs are really, insurance works best when you get yourself insured as early in life as possible, right? And I say insurance, I'm not talking about an insurance investment scheme. I'm talking really about a health plan, right? A health coverage, because today the medical costs are increasing so much that if you don't have I think like majority of the people out there are just one health incident away from kind of going into a financial ruin, right? So it's very important to pick up a health insurance and get as much coverage as possible, and try to get everything covered, all kind of outcomes covered, even if it were to cost you a little, so I would even go to the extent that even if it were to cost you like 10% of your income to get your health insurance covered, just do it, and do it quite early in life. Because if you do it early in life, then when you get older, the premiums don't go up as much. If I don't get myself insured early in life and I go try to get insured very late in life, the cost of insurance also goes up, right? So I think it's very important that one is, of course, you need to take care of health, so that's a given. So if you take care of your health, like your ability to earn also increases, and you also postpone the highly likely that you'll postpone the health event as well. But apart from taking care of health, it's also very important that you are taking some kind of a health insurance policy. And if you're if there are dependents on you, also go ahead and take some term insurance policy, right? Because when we talk about money, finance, etc., at some point, maybe not at 21, 22, but by the time you're in the late 20s, you're probably getting married, and then you'll have your wife, and then you'll have kids, and then you'll have dependents, right? So it's also important to think about them, in terms of what will happen to them if you are not around, if you are the kind of the breadwinner of the family. So it's also important that you go and get a term insurance policy. So the way back in the day when I started first earning, the way I thought about it was that if say I'm making 3 lakh rupees a year, I'm contributing 3 lakh rupees a year to my family. So my insurance policy should be such a way that if something happens to me, the insurance policy kept in a fixed deposit gives my family 3 lakh rupees a year, right? So which means that, 3 lakh rupees is say 7% of say 50 lakh rupees, right? So my insurance cover should be at least 50 lakh rupees. So when something happens to me, my family can take this insurance money, put it in a fixed deposit, and and get that 3 lakh rupees a year. So there is no there's no issues because I'm not around. As in, so I mean, 3 lakhs and 50 lakh rupees are just examples, but a term insurance policy is quite cheap. So I think everyone should also go and get themselves a term insurance plan as well, right? So yeah. So I mean, this is really. When I think about youngsters and think about finance and and getting started, I think these are the most important thing. Trading stocks, trading futures and options. I mean, these are all think of it as entertainment. If you enjoy it at some point of life, allocate small amounts of money because it's a very high risk thing to do, and if you find that bit, if you find it something that you're really good at, maybe only then give it full time. Otherwise it's best to keep it as a side time, like a part-time hobby where you give small amounts of time and money. Yeah, Anurag, hopefully I made some sense.
Thank you so much, Nitin, for your exciting and so many thoughts about young people. So the natural question that comes to my mind is, where is Nitin investing his money?
Yeah, so I have a younger brother, Nikhil, so who manages the money. So I mean, so when we started Zerodha, the way we did this was that we decided that he continues trading, and I will go build a business. And so I really ever even ask him what he does with the money. But generally, what I do personally, which I enjoy, is through Rainmatter FinTech, we invest in FinTech startups. And now through the foundation, we are helping nonprofits. So, I mean, these two are things that I do, but the way we think about these investment is more for impact than for any ROI, in the sense our investments are done saying, will this startup help the capital market ecosystem, or will this startup somehow solve for something else, or is this not for profits going to help world become better in some way? So I mean, I'm doing more impact investment where I don't really have to care about any return of money, or what is the ROI in absolute terms of sorts, in terms of percentage. Nikhil, I mean, I mean, we are generally, I think right now he's a little pessimistic about the world. So we are more long fixed income than and gold, and not really as much of stocks.
So is that some sort of suggestion to young investors as well to go heavy on that?
Not really. I mean, I know the thing is, we are kind of, I don't know if we are the right use case on how we should do money. I mean, so we are beyond that thing where I have to worry about, like I don't have to do SIP and all of that, right? So, I mean, it's a, I was very lucky in my life to have had this outcome because of the business. So I don't really have to worry about stuff like that. Today for us, the thing is to make sure that there is as little volatility in our personal lives. Right. So because now being a stockbroker, there's already enough volatility. So in our personal savings and investing, we don't want to bring in too much of risk and volatility. So we are very conservative in that way. But I think youngsters today should. I think India is one of the, like, I think, if I had to put my money on this longer term, India is going to be a super, like a power, it's one of those economic powerhouses of sorts of the future. And Indian investors should be long India, right? As in, you should buy into India in some way or the other. I mean, if you're working in India, you'll anyways get to play a part in it. But people, once they're ready to start saving in the markets, I think one of those index funds is probably the best way to play India.
All right. So in your conversation, Nitin, you touched on natural progression from FD to mutual fund to direct equity. Then you talked about insurance, diversification, etc. You also took an example of an investor investing into mutual fund where if he loses money initially, then he's not coming back to market for long. But right now, in last 2-3 years, it's completely the other way. So many investors have come and they've made a lot of money into direct equity. Is that not a risk of some sort?
No, it is. This is something that we question ourselves. I mean, see, we've been a big beneficiary of this, right? As in, or whatever, the bull run in the last 2-3 years. But it is, like I said, internally, the biggest discussion we have is how do we temper down people's expectation? Because I think the big problem over the last 2-3 years is most people who have come to the markets have come with almost like a wrong expectation from the market. A lot of social media noise, a lot of people claiming that they made quick money, and we are using every opportunity possible to tell people that there is no quick money in the stock markets. If you make 15% compounded per year on year, long term is an amazing return, right? Because today I speak to so many people who think they can make 15% month on month, and I keep telling that, so it's there is no way anyone can make 15% month on month, right? So this is something which is on top. Even within our platform, we have never once pushed our customers to take a trade. We have never made it seem like markets are easy. We always constantly said that market is a hard place to kind of make money from. And we have stayed away from leverage. So we have never given customers leverage to buy more and etc. So no, but you're absolutely right. It's a big concern. I think the right problem to solve for in this country right now is that we've got so many first timers to the market in the last few years. Now the question is, how do we make sure they make as little money mistakes as possible? Now, the good thing for the last 2-3 years is because most people are young, the money at play is much lesser, right? One of the one of the silver lining I have is that even if they were to make money mistake, they make it with small amounts of money. So they learn from it and they get better at it. That's, it's a potential silver lining, but maybe I'm too hopeful about it. So.
All right. So the next question, Nitin, that I have is, all people, government, regulator, exchanges, brokers, tried very hard for last 25 years to, increase the investor base beyond 2% of Indian population. They were not able to do it. What exactly happened in last 3 years, right? So it was a blessing in disguise, whatever. But what exactly happened that the base increased to straight away 4, 5, 6% of Indian population? And do we have more scope?
Yeah, no, see, the thing is, there were a lot of fence sitters all the time, right? There were right from when I started trading the markets, there were so many of my friends who would keep asking me how to trade, how to invest, but they would never plunge in the sense, they would always sit and watch, right? I think what happened is, when COVID happened, firstly, there was a lot of free time. Second, I think people's savings increased, people spend less, so they had more money on them. And there was also market doing well. So there was also greed. So I think it was like a potent combination of these three things that got a lot of people who never thought about stock markets to start thinking about it, right? But here's the thing, in India, if you look at it, right, in India by, in terms of earning power, I don't think, 5 crore Indians filed an income tax returns, right? As in now, even if you were to assume there are 5 crore more Indians who didn't file, who can potentially file, so your audience still becomes 10 crore Indians, right? As in, I don't think, we should look at India as 150 crores and look at a percentage. I think we should look at India as 10 to 15 crores, people who have enough money to save and invest, and look at the penetration in terms of that. Now, if you look at India as 10 crore as a potential market size, and there were 2.5 crore Indians who traded once a year last year, right? So 2.5 crore is 25% of 10 crores, and it's not a bad number. It's a decent penetration. I think the real problem to solve in India is how do we make sure the rest of India kind of goes up the per capita, right? As the country does well, I think the potential market size increases. But today, the market size, in my personal view, is not more than 10 to 15 crores. 15 crores would be a stretch, but I think 10 crores is probably around the number in this.
Good point, Nitin. Another point that you touched was invest into India.
Right.
Is it kind of thinking that we are decoupled from the world? World
Right.
is losing market capitalization. We are still there, kind of increasing, and you are still suggesting on as of now investing into India or not, or wait for some time?
No, I don't think we should get into the business of timing the market, right? I think it's almost impossible to call. What we're seeing right now is just not India. I think some of the emerging markets, if you look at Brazil, for example, that was also not, the last 2-3 months didn't catch up. It hasn't fallen like how US is. It's been very similar to the Indian markets. I think, across the world, I think there's a big play happening, which is emerging markets will outperform developed markets over the next 5-10 years. right? I mean, this, what you're seeing, the divergence in stock market performance, I think is part of that, thesis, which is like countries like India, Brazil, even Russia, for example, for everything that's going through, the stock markets are not too bad of sorts, So, so I think generally there is this whole theme that, I think some of the emerging countries will do much better than developed. And that's why, we as a country are not, falling. But the thing is, I don't know how long can the divergence stay, but eventually someday, right? If US markets keeps falling like the way it's falling, eventually someone will say, you know what, I think it's too much more divergence, and then there'll be, trades taken. So, personally, I think there's going to be volatility for sure. I don't think the next 3 years would be anything like the last 3 or 4 years, So, but India, longer term, which is 5-10 years out, if you think about it, we have the highest number of 20 to 30-year-olds in the world. We it almost looks like we'll have a stable government for the next 5-10 years. We are one of the only few growing economies in the world, growing large economies in the world. So, and there's so much interest from foreigners to put money into India. So, it's all of that seems like a very potent combination for India to do well over the next 5 to 10 years. So I don't think people should try to time this. Like I said, if you want to be long India, take small amounts of money, buy an index fund, and keep doing it, and not reduce or slow down or stop if there was a market fall. So.
Nice thoughts, Nitin. In one of my earlier conversations, I heard you saying that you're a stockbroker by chance or something. That's okay, history, but where do you see yourself in next 10 years?
Yeah, no, I mean, see, the thing is, we started Zerodha, and I used to be an active trader, and we started Zerodha saying that we will help active traders do better. And slowly the journey became, the whole, over the last few years, the way we are thinking is that we need to help people do better with their money, right? As in, I mean, the reason we exist is for that. And have we done enough? I don't think we have done enough. I mean, we need to do a lot more to help our customers do better with their money. Of course, we have a nice platform. You can do easily, you can trade easily, you can do analysis, you can do it at low cost. But I think our obligation is a lot more than that now. And generally, internally, everything that we are talking about and thinking about is how do we really help people do better with the money. I don't know what I'll be doing in 10 years from now, but I'm hoping in the next 1, 2, 3 years, we'll be able to leverage tech in some way to create some impact there. It's very hard. It's very hard because people have, every individual is different. Every individual has his own biases. How do we, even if we found a solution, how do we nudge a customer to do what is right for him, or even convince him that it is the right thing to do, So it's these are all tough challenges, but I think these are very exciting problem statements, and this is something that we are all internally working on.
Great, Nitin. Thank you so much. It was really interesting to speak to you. Thank you once again. And I'm sure our audience, especially younger ones, path to financial freedom will be much easier now after listening to you. Thank you so much. See you around.
Yeah. Thanks, Anurag. Bye. Bye.
Good afternoon, Rachna. Do you hear me? Can you hear me, Rachna? Oh, great.
I was not able to unmute myself, so now I can. How are you?
I'm good. Thank you so much.
I'm so sorry, I can't hear you. Could you come again, please?
Thank you so much. Do you hear me now?
Yeah.
All right, perfect. So it seems, Rachna, that the organizing team of this event was most kind to me.
Acha?
After Nitin Kamath, the next speaker assigned to me is equally passionate and playing her role to bring investors, especially younger ones, to the markets and educating them on the path to financial freedom. So keeping up with the same topic, now I have with me audience Rachna Fatke Ranade. So allow me to introduce Rachna for a couple of minutes. Rachna is a chartered accountant and she chose teaching as career at very young age, wherein she taught CA and MBA students for a period of 10 years. She started her YouTube journey in 2019, and today she is one of the India's leading financial influencers. She has achieved the milestone of more than 3.8 million subscribers on YouTube and more than 760,000 followers on Instagram in a span of 3 years. She has also listed 7 courses related to stock market and personal finance on her website with more than 150,000 enrolled learners. Her competence in explaining difficult concepts in an easy, simplified, and fun-filled manner attracts professionals and beginners alike. She focuses on teaching the basics of stock market and helps an inspiring investor to become a professional investor. She is Sangeet Visharat and has performed at various music shows all across India. She was also a part of Rahmania and had a great opportunity to be on stage with A.R. Rahman. She has sung on Radio City twice and has also sung 2 Marathi songs in a music album. Rachna, I'm sure our viewers are eager to listen to you. Please go ahead with your thoughts on the topic, a young investor's path to financial freedom. Stage is yours. Thank you.
Thanks a lot, Anurag, for that wonderful introduction. I got a little bit tensed hearing to what you told about me. I think too much more, but thanks for that wonderful introduction. Well, I think today's topic that has been given to me is really important and a topic which is very close to my heart, which is about young investors' path to financial freedom. So, being a teacher, I would want to crack down onto each and every word. So, young investors' path, chalo theek hai, young investor, so we understand. But what is financial freedom is a term I think which I should explain first, because everyone has their own thought process, everyone has their own definition about exactly what is financial freedom. But if I were to put it in a super simplified way, if I were to tell what is financial freedom according to me in just one line, it is something like you work because you want to work, you don't work because you have to work. If this is sorted, you are financially free, right? So in simple words, you are working because you are passionate about your work and not out of any compulsion. So if you are able to do that, I think you're all set. You can pursue whatever you want to after that. Now the big question is that being young investors, should we be really investing from a very young age, or is there any ideal age for investing? Should we be starting at 30s, 40s? What could be a young? How do we define a young investor, basically, right? Now, I would want to tell some channel statistics of mine. So when I started my YouTube channel, I had a lot of people in the 40 plus category, in the 40 to 50 age group, right? Slowly and steadily, when lockdown happened, 30 to 40 started booming. But a category which started booming faster was in the 20 to 30 category. So, and in fact, there is a category which comes into the 13 to 20 or 13 to 18 kind of a category. That also showed some spurt in the number of participants on my channel, at least. So I think earlier the better is what we always use in any parts of our life journey, and I think the same logic works for investing as well. Unfortunately, in a typical Indian household, including households like a background that I come from, a Marathi middle class background, I think talking about money is still considered as a taboo. And whenever father and mother is talking about money, and if children were to come there, they'll be like, usko pehle bhagao. First, ask the child to go to study. Once the child is gone, then we'll continue our discussion about finances. So this is what happens in a typical Marathi, or I think any Indian household, is what I personally feel. Majority of the Indian household is what I feel. And then we say that, Warren Buffett started investing at 11. See, if we don't change our thought process, how can we have more Warren Buffetts in India? So if we were to give our own examples, this XYZ Indian girl or XYZ Indian boy started investing at an age of 11, started investing at the age of 12, then I think we should be encouraging kids to learn about finances. Okay, I'm not at all saying that they should start trading, they should start participating in stock markets. Not at all. Finance is much wider term. Investing again is a much wider term. We should not be looking at it only from a very narrow perspective of trading, right? Because the discussion that we are doing here is about a financial freedom. So finance is a much broader term, right? Just to give you a simple example on how we can involve kids even at the age of 10 for finance, to understand the term of finance. I'll just give you a simple example for that. So the society where I live, they are going to have a fun fair, okay? And they have told every resident to participate in the fun fair. Anyone who wants to put up a stall, you are allowed to do that. So we have been told that every single person who wants to own a stall will pay 850 rupees as a rent for the stall, right? Now, what I've told my son is that you are going to put up a stall. My son is in grade 4, okay, age 10. And I told him that, okay, what is this 850? 850 is your cost. So if you were to make a profit, how much do you have to make? So you'll have to make something more than 850. So 850 is like your break-even point. So I'm teaching him some small concepts like break-even point, like variable cost, like a fixed cost, through this small fun fair activity. Now, can I say these steps, these are the small steps which can instill a sense of inquisitiveness in the field of finance. So he can keep on asking me more questions about that. And for dhire karke, he can go to advanced level of questions, and then I can introduce him to the world of finance, to the world of investing, maybe, right? So I think that earlier the investing age, the highest investing age, which was around 40, became a bit younger. Now people in 30s started investing. It became younger. People started investing in 20s, and we want to take it to the next step where even kids going in high school, maybe at least, should talk about finances. Again, I'm repeating my line. I'm not encouraging them to trade at all, but they should be aware about something like finances. In fact, I personally believe that we learn a lot of topics in school, which we never ever use in our life. I remember we were taught about French Revolution in 8th standard. How on earth have I made, how on earth does that make any sense to me? I mean, I never ever even, reread about what happened in France and what was the French Revolution all about. But an important subject like personal finance, unfortunately, even today is not taught at the school level. So I personally believe that if we have a history and civics split, which we typically have at Maharashtra board, at least, I'm not sure about other boards, we have a geography and economics split. Similarly, I believe there should be a split in maths and finance, where at least a 10 or 20 marks weightage, if we give to finance, if we introduce them subjects of finance, simple things. What is the power of compounding? What is insurance? What is investing? Only basic concepts. I think that will start the journey of finances, that will start their brains in that direction, and then they will be able to make a decision. Chalo, should I be choosing this as a career option or not, right? So these days, still, I'm really happy that people are being more inquisitive about finance. In fact, I have had many experiences like this as well. Like if I go to any birthday party where my son is invited, of course, there'll be some friends from his school who know me, but there'll be some other people who will be invited at the party as well. So I remember a kid from grade 3 or grade 4, he came to me and he said, "I know you, Rachna ma'am." I was like, "Really? You're from grade 3 and you know me?" He said, "I've seen you on my mama's mobile." Like, kya baat hai? He said, "You are my next gen subscriber." Right? So at least, see, they might not understand what I'm talking. That's fine. But at least हम जो होता है ना, कान पे उनके कुछ ये words सुनाई देंगे. They'll get a base level of introduction about this entire area. Now, one thing is getting to know about all these things, but once they are aware about some basic terms, right? Then the big question is, how do they kickstart their financial journey towards their ultimate financial freedom is the next big question, right? Now, I personally believe that these days, a lot of kids do get pocket money. Or even if we are talking about many a times parents do say this, that okay, we'll not give you pocket money, but you tell what you want the money for, and we'll give it to you. So I think step number one, which any person should start the moment that person turns 18. I'm not talking about minor investing, right? Because there are certain rules, restrictions. They are not allowed to trade. So I'm just considering any person above 18. The moment that person turns 18, why can't that person start an SIP in an index fund with as low as 500 rupees, right? So I think that can be a very, very basic thing to kickstart their investing journey. In fact, there are many mutual funds. I would not want to name any, but there are many mutual funds wherein investing can be done with an SIP of as low as 100 rupees. We know about the overall Indian story right now. Entire world is talking about how India can perform in the coming 10 years, how we are doing better as compared to other countries globally. And if you at least tell them कि जो हम अपना टाइम आएगा, ये रणवीर सिंह का हमने गाना सुना है, तो अपना टाइम आ गया already. We are at the cusp of this financial revolution, and I think this is the time when we can introduce our kids in this journey of investing by encouraging them कि चलो 100 रुपए पर मंथ तो हम लगा सकते हैं, 500 रुपए अगर पेरेंट्स कुछ और दे रहे हैं तो वो भी लगाया जा सकता है. And with this experiment, they can tell them about how this money can compound. And over a period of years, this 500 put together, boon boon se hoj banta is what we say. So I think they will be able to experience this through their journey. One more very important aspect of we investing in mutual funds, typically an index fund SIP, best part I'll tell you. Assume that I'm talking about a person who starts investing in an index fund at the age of 26 or 27, 28, whatever, when he starts earning. Maybe he has just gotten married and he has zero experience about investing in mutual funds. Now, some random person can come up to him and say that, भाई mutual fund में सब बोलते हैं सही सही है, लेकिन mutual fund में भी तो पैसा डूब सकता है. Are you sure you want to invest or not? डरा तो सकता है कोई भी. तो 26th या 27th एज पे डरने से अच्छा है कि आप 18th बर्थडे पे ही अगर आप आपकी जर्नी स्टार्ट करते हो, तो by the age of 26 you already have 8 years under your bank, right? And that is where you can tell confidently कि भाई पिछले 8 साल में पैसा गवाया नहीं है, कमाया ही है. So I think that confidence can help that person to invest a larger amount at a much higher confidence, right? So I think the step number one that every person, the moment that person turns 18, step number one, start investing in a mutual fund, in a SIP route, and which can be done through a something very basic, something very simple, can be like a Nifty index mutual fund, right? What can be the step number two? Very important. I think any investment is useless if there is no apt amount of insurance. If you are insuring yourself at a very young age, somewhere around at 18, you can imagine what low premiums will that person enjoy for a majority of his life. There are many insurance companies who offer insurances of 30 years, 40 years, 50 years. If that be so, तो अच्छा, और एक बारी आपका प्रीमियम लॉक हो जाता है तो that gets locked, right? So if it is getting locked at the age of 18, where your premiums are very low, then why not? Why would not anyone want to do that? So I think second thing that you can do for ensuring financial freedom is taking an insurance at, typically a term insurance, at a very young age, right? फिर आती है तीसरी बात. So one I talked about investing, one I talked about insurance. Now let me talk about loans. This might not happen at the age of 18, but the moment you start earning your first salary, that is the time when people start seeing other friends taking flashy cars, when we start seeing our friends buying a house, and that is where the FOMO kicks in. Am I missing out on something? I have not yet bought a house. I have not yet bought a car. And in that FOMO, there is a great possibility that people might spend an amount which was actually way beyond their budget. So whenever you are wanting to buy a car or you're wanting to buy a house for that matter, the first things first question to be asked is, do you really need it? Okay, so I always say that first things you have to check, do you really need it? One. Number two, can you afford it? Because you may feel that I need it, but if you're not able to afford it, better take it on rent rather than actually putting a heavy financial burden at the beginning itself. I think the biggest achievement that you can have is not taking a loan at a very, very young age, because you will be burdened at I mean, तो मतलब वो बोझ से ही आधे लोग ऐसे हो जाते हैं, अरे यार अभी क्या है, अभी तो आधे से ज्यादा सैलरी तो ईएमआई में ही चली जाती है, अलग अलग लोन्स पे. In fact, I'll just tell you one experience. I met one of my students and I said, कैसे जॉब चल रहा है तुम्हारा? He had just started a job. तो he said, मैम सही बताऊं? मैंने कहा बोलो. He said, पहले जॉब अच्छी नहीं लगती थी, फिर मैंने होम लोन ले लिया, अब मुझे जॉब बहुत अच्छी लगती है. So you are actually left with no choice but to slog yourself in whatever area, but you want money so that you can pay off your EMIs. So very crucial point if you want to achieve financial freedom is that please don't take unnecessary loans. Taking personal loans for nonsense reasons is the worst thing that you can do. Personal loans should be avoided, should not be taken as far as possible. People say that Rachna, we have emergency sometimes for very short time में भी कि कुछ 10 दिन के लिए पैसे लगने वाले हैं, तो क्या ही कर सकते हैं, पर्सनल लोन ही लेना पड़ता है. So there are alternate choices, right? So something like an OD on FD, overdraft on your fixed deposit, that is also doable. So, and of course these are to be done with absolute care. We should not be using that money to go shopping, but it can be used to meet some emergency, right? So third important point that I wanted to give for achieving financial freedom at a young age is take minimal loans as far as possible. Avoid taking those loans which are super expensive, something like a personal loan, right? Moving on to the fourth point, stay away from all the fascinating things, something like F&O and crypto. Because if you are a young investor, see, I'm not joking at all, Anurag. I have seen so many people in their 20s whose first investment is in cryptos. I think that is a very wrong strategy. That is not going to, I mean, it's such a high risk, high return category of asset. Ideally, you should not be kickstarting your investment journey with something which is a very high risky asset class. Neither should you be going ahead with F&O to kickstart with. लोगों को क्या लगता है यार 600 रुपए में एक लॉट आ रहा है, 1000 रुपए में एक लॉट आ रहा है, तो कितना ही पैसा जा रहा है. They look at F&O more like buying a lottery ticket. लगा तो लगा. So that is not the way you make money, right? चलो ठीक है, एक आधी बार तुक्का लग भी जाएगा. So you may make money with F&O, you may make money with crypto, but you will generate wealth only with investing. So you have to decide whether you want to make money or whether you want to create wealth. If you want to create wealth, there is no shortcut. It has to be through disciplined investing, and that will come only with systematic investing over a longer period of time, right? So I'll just quickly wrap up 4 points that I talked till now. The very first point I said that you can kickstart your journey with index funds as low as 100 rupees, 500 rupees, SIP pattern. Second thing, you can go ahead with a term insurance at a very young age so that your premiums are very low. Third thing you can do is avoid unnecessary loans. Something like a personal loan is a big no. Fourth thing, I said that if you want to just for fun, some people want to invest, but that's not the right way to do that. Don't invest. I mean, crypto can't be your first investment avenue is what I personally feel. F&O is maybe just for fun, but that's not the way to create wealth. So avoid at an early age. And fifth investment, last investment that I would want to talk about in today's session is the investment that can give you the best returns. And that is investing in knowledge. Because if you know where your money is invested, if you know everything about that, then only you will have the conviction to hold it for a longer period of time. So for example, even I started my investing journey when I was in CA final. So I might have been somewhere around 18, 19, maybe 20 years of age. That is when I started my investing journey. But when I invested in the initial few days, I also didn't check any basic points, something like fundamental analysis. I never did that. So किसी ने बताया, किसी के टिप के बेसिस पे ले लिया, but I never had a conviction to hold that. क्यों? The moment 1% नीचे गया, 2% नीचे गया, मेरा BP बढ़ते जाता था. यार अब क्या करेंगे? Because never ever had I studied about that stock. But then when I learned how to analyze the stock, how to check certain basic financial parameters, that was the time when I started investing in stocks, and that too with 100% conviction. So I think at an early age, your focus should be on learning more, on investing in knowledge. That is that investment which can take you, leaps and bounds in your entire investing journey. So yeah, I think that is very important, and that is the whole and sole reason why, like you mentioned, I have started a website rachnaranade.com, and wherein I've taught 7 different courses So something like a beginner level course, intermediate level course, advanced level course. So I think, and I'm so happy that even kids who are like in grade 6, grade 7, I had a kid in grade 6 who was attending my fundamental analysis batch, and he was asking me a doubt about debt to GDP ratio. And I was taken aback when a 6th standard person was asking me that question, debt to GDP ratio. I said, hey Bhagwan, when I was doing fine CA also, I did not know about that ratio. But I think that is really important, that you should be giving that much time to invest in knowledge. And that's what I've been doing this year. Just to wrap up the session, like our Prime Minister Narendra Modi ji has talked about Har Ghar Tiranga, I'm doing a Har Ghar Investor campaign. And that is the reason why I'm taking a lot of webinars, I'm doing a lot of seminars, taking up more courses. So yeah, that's the whole thought process for this year as well. I think I was able to sum up top 5 points for any young investor who wants to kickstart their financial journey and achieve financial freedom at a young age. Thank you.
Great. Thank you so much, Rachna. This was so interesting. I think you touched the right point that, students in the school are taught about compounds in science, but there should be more stress on power of compounding in mathematics. People are more, people come out literate, but may not be, necessarily financially literate. All that is required at school level. We have been from BBF side also, touching this, in one way or the other. So coming to, there's something in my mind as well, right? Some questions are cropping up.
Sure.
Again, so I asked Nitin, so couldn't get a very clear answer, but I asked, expect that from you. Where are you exactly investing?
Where am I exactly investing? Like Amitabh Bachchan has taught us, मेरे पास गाड़ी है, मेरे पास building है, मेरे पास bank balance है. So if Amitabh Bachchan can diversify, why can't we? Right? So the same logic I'm using. Not Gadi is not an investment, but it's bank balance, of course. I do invest in FDs. I do invest in shares. I do invest in mutual funds. I have investments in gold. I do invest in bonds. I have put some money for fun in cryptos. But that I have a concept known as party fund. Only party fund amount goes to crypto. So party fund essentially is a concept like, if I were to go out for dinner with my friends, how much money can I spend over a party? So if I have that much financial capacity, चलो दोस्तों को लेके गई, 10,000 रुपए एक रात में उड़ा दिया over a dinner, तो I have the capacity to lose 10,000 easily. उससे मुझे कुछ फर्क नहीं पड़ेगा. So that is the amount that I would allocate to cryptos in a month. So that is the way I decide my own budget of how much will go in a high risk, high return category asset class. Just to quickly touch upon FDs, I have seen a lot of finance influencers saying that पागल हो क्या, FD में क्यों पैसा लगाते हो? I think investing in FDs is a must, especially to meet your short-term goals. Equity and mutual funds are a very good investment if you are wanting to cater to your long-term goals, but they can't be used to cater your short-term goals. मान के चलिए coming month of July or June, I want to pay my kids' school fee. I can't say I'm going to invest in equity so that I can fund my son's school fee. So and तब अगर market नीचे हो गया तो, right? So FDs is a very underrated thing these days. But I feel if you were talking about a short-term goal, that time returns is not to be considered. Safety and liquidity is what is to be considered, is to be given higher priority.
Great. Nice. So you touched the point on SIP as well. My personal experience, I remember just last week, my wife came with a statement saying that, this is what I have as an investment. She's doing, investment for the last couple of years. She said, this is PF, this is etc., FD, etc. Then she said equities. So she gave me a figure. I said, no, Pagli, ye to 1 0 extra lag gaya, isko theek kar. Then she came out again. This is correct figure. SIP, right? She's doing it for last couple of years. So great one. So that's how young investors should invest into capital markets.
Definitely. Sorry to cut you. I also have a different full form for SIP. Rather than a systematic investment plan, I say it's save, invest, and prosper.
Correct. Actually, I prospered 3 days back.
True that.
How bullish are you in India?
101%.
Right. Okay, great. So again, so from long-term perspective, everybody says India is, we have to be bullish on India. Any views in short term?
I think no one can tell about the short term, right? When everyone thought that Russia and Ukraine problem, whatever is ongoing, is maybe sorting out a little bit, and we saw what happened about the bridge just a day or two ago. The moment we thought that, okay, OPEC countries might not be cutting down on the production, suddenly we got to know that, hey, Bhagwan, they're going to cut down on production. Crude oil, which had come to almost, if I'm not mistaken, 80 to 85 level, bounced back above 95 again. So, because short term, there are a lot of things. Even if I talk about Europe, achanak se started quantitative easing. You might have read that news. Maybe just 3 weeks ago, they announced that we are now going to start off with quantitative easing. 2 days ago, they said now we're going to stop that, and maybe we can go ahead again with quantitative tightening. So there are a lot of things which are totally beyond our control, beyond our imagination, which can happen in the short term. So I always say that only two people can give the correct view in the short term, 100% correct view. One is God, one is a liar. So I'm none of them. So I can't tell about a short term, but yeah, for the long term, I am bullish.
Great. Thank you so much. It was so listening to you was awesome. I hope we could listen to you for another couple of minutes. I'm talking about another couple of hours. But right now, I got alarm from the backend team that we are overshooting the time. We will be overshooting the time soon. So allow me to wrap up the session here. And a very big thank you to audience for giving time and listening to us patiently. It's time to hand over to Alok Churiwala, who is the moderator for the next session. Once that's straight from Legions, okay. And thank you, Alok. Are you here?
Yeah, I think he just got disconnected. He'll be joining again.
So we could continue for a couple of more minutes then. Yes.
Surely.
Dil mange more.
The markets and man has to go up, right?
Alok is here the moment we talk about markets.
Hi, welcome, Alok.
Hi, Anuragji. Hi, Rashna ma'am.
Hi, how are you?
Very good, very good. And you know, just as I got in the room, I was thrown out by technology. Anuragji, have you tweaked the system?
I wanted to stay for some more time with Rachna.
So, Rashnaji, I would urge you to stay on because the next 3 sessions that we are having are going to be really interesting and blockbuster sessions. So if you can, I know you have a very busy schedule, but if you'd like to listen in, we'd be delighted.
Thank you, Alok.
Thank you, Naragji. With this, now we move over to our next session. Hi, I'm Alok Churiwala. Investors are the raison d'etre of capital markets. We at the BSE Brokers Forum, under the aegis of International Forum for Investor Education, are celebrating the World Investor Week. India Investor Show 2022 is a 3-day event with participation of galaxy of stars from the capital market domain, starting from the regulators to Ministry of Finance, market infrastructure institutions, to mutual funds and market intermediaries and investors, of course. The Indian investor has never had it so good. From lowest transaction cost to the highest speeds of execution, a plethora of products to choose from and deal in a safe and secure, transparent environment. Growing retail participation can be born from the fact of increasing number of demat accounts and growing SIP figures. This shows not only the confidence of the investors, but has also helped soften the blow from negative FII flows. The credit of all this goes to SEBI and MOF, ably assisted by the market infrastructure institutions and intermediaries, of course. Our session today is straight from the legends. Today, I have great pleasure in introducing our first legend, Shri Prashant Jain. A quick introduction about Prashant ji, although he needs no introduction. Prashant Jain was Chief Investment Officer at HDFC Mutual Fund from 2004 to 2022. he has handled funds under him. The asset base grew from 3,000 crore to approximately 4,40,000 crores. He has 31 years of investment management experience. He has managed the scheme for over 28 years. One of the rare distinction of being the only fund manager in India and very few globally to have managed a scheme for over 28 years. Some refer to him as a contrarian investor, some a value investor, but he considers himself to be a rational investor. He has completed his PGDBM from IIM Bangalore in 1991, and prior to that obtained a bachelor's degree in mechanical engineering from IIT Kanpur. With these brief words of introduction, over to you, Prashantji.
Thank you, Alokji, and thank for this opportunity. It's a pleasure to be connecting with all the investors, capital market participants on this forum. And I'll speak briefly about the outlook for India's economy and of capital markets, and I'll be happy to answer a few questions thereafter, time permitting. I think India's economy has great potential, and there are 2 or 3 key reasons why we believe that. Number one, our demographics is now probably the best, by far the best amongst all the large economies of the world. Japan has been aging for close to 40 years. Europe is aging now for maybe 15-20 years. Interestingly, China has begun to age for the last 5-7 years. And in US, the working age population growth has also come down very sharply. So net, these 4 geographies, US, Europe, China, Japan, which probably represent more than 2/3 of the global economic size, they are faced with a declining working age population. And this is happening at a time where India's working age population will continue to grow for the next 2 decades. And also, interestingly, in COVID, the work from home has become acceptable. So I think these two happening at the same time, sourcing of services to India in a remote setting. And this need not be limited to software and BPO, but I think a whole host of services like R&D, back office, accounting, taxation, legal work, whatever can be done from a remote setting. I think we should see significant increase in that. And this, I think, will create large number of jobs in India, which of course should lead to higher consumption. And as we all know, India is an income constrained economy. The real challenge is to grow incomes. So these large number of jobs that should come our way, I think once they give purchasing power to people, consumption growth is a very natural outcome. The second opportunity that we are faced with is the improving India's competitiveness versus China in manufacturing. China has grown rapidly, and one of the consequences of that rapid growth has been the very fast increase in per capita incomes. So India's cost of manufacturing today compares favorably with China. And also due to the challenges faced in lockdown due to over-dependence on Chinese supply chain, the world wants to de-risk over-dependence on China. And again, from a geopolitics perspective also, I think India has emerged as a clear favorite destination. India by itself is a very large market. So if you make here, you can make for the local market as well as for the export markets. So I think India should be able to attract large number of multinational companies to set up manufacturing facilities in India, which they have done in China thus far. And this again should lead to, should aid faster growth of the economy. India, meanwhile, has carried out some important reforms. We have improved the business environment, the investment climate in the country. And some of the key reforms which we are all familiar with, I think GST plus use of digital cash I think will make tax compliance better. We are seeing that in increasing tax revenues for both direct and indirect taxes. The focus on infrastructure and logistics will improve India's competitiveness. RERA, I think it will lead to formalization, better work practices in the real estate industry, a very large industry. And the focus on Make in India, Atmanirbhar Bharat, the PLI scheme, I think all of these will aid local manufacturing. So net, I think India's ease of doing business rankings have been improving. We hope to break into the top 50 in the foreseeable future. And given the local efforts, the improving outlook, the export opportunity, the outsourcing opportunity in manufacturing and services, great demographics, I think the potential for growth in India is immense. And next 2 decades, we should experience very healthy levels of growth. And we should quite soon become a 5 and thereafter 10 trillion economy. And without doubt, I think amongst the largest economies of the world, India should grow the fastest. And this is visible in the increased foreign investments. Our FDI inflows are pretty large and they continue to increase. And I think that is a measure of how the large foreign companies look at India. Coming to capital markets, I think India's markets have demonstrated outstanding resilience in the face of falling markets across the world. And I think this is a tribute to the local investors, the distributors, the banks, the mutual funds, the regulator, everyone who has contributed to improving the understanding of equities in the large number of Indian investors as a long-term asset class. And what we saw in the last few quarters when FII sold between 30 to 40 billion US worth of stocks and markets held firm, the result of the collective decades. I think equities have moved from a peripheral or a seasonal asset class to a core asset class. And that is what we see in the rising number of demat accounts, the rising SIPs, and the increasing retail ownership of markets both directly and indirectly. So I think this is what has explained India's resilience, the sharp gain in local flows. And I think this is here to stay. Having said that, the markets are now close to fairly valued. If at all, they are trading slightly above longer term averages. And therefore, one should not expect very high returns on these markets. I think bulk of the returns over next 3, 5, 10 years should come from economic growth, from corporate growth, from growth of corporate profits. And the room for multiples to move up, I think, is quite limited. I think India's nominal GDP, roughly speaking, it should grow around 12% a year, next 10 years, thereabout. So I think that's a reasonable guess of the returns from the diversified portfolios. What are the risks? I think there are 2 issues that I would like to highlight here. One, the cost of capital, especially in the West, is going up after declining for almost 4 decades. And the last round of easing, the last round of foreign capital was a result of COVID and the reaction of governments and central banks to handle that. And that is clearly now reversing. If the US cost of capital remains high, if it goes up further, it is possible that we may once again experience some selling from foreigners, as we have been witnessing for the last few days. It will be interesting to watch whether this time around local flows are as strong as they were in the last round. Few things to keep in mind. The ownership of equities with retail today is much higher than what it was 2 years back. Second, many people have not really earned returns over last 1 year, 18 months. And it is possible that a section of these investors may be reluctant to add more when their immediate experience has not been good, though that's not the right time frame to measure equities performance. And the third thing that we need to take note of is that few quarters back, 1 or 2 years back, bank deposit rates were extremely low. Now we are in a situation where the credit growth of banks, the loan growth of banks is exceeding the deposit growth by 6 to 7% a year. This, I think, should lead to higher deposit rates. If and when banks start offering high single-digit rates on deposits, it would be interesting to see whether there is a shift back to some extent from the equity flows to the bank deposits. And therefore, net, I think, given the valuations, given this issue of rising cost of capital in the West and rising bank deposit rates even locally, I would say that while equities remains a great asset class for someone with a 3, 5, 10-year view, I think at this point of time, one should probably keep a little money on the side, that in the event, if markets correct, one should be able to add to that, because the US cost of capital going up is a very important event, and either one should let this pass, then one should get fully invested, or one can keep a little money to take advantage should the markets correct. To summarize, I think the outlook for India's economy is probably the best that one has seen in a very long time, and it is a result of many local improvements that we have carried out. The prospects of significant increase in export of services, prospects of significant improvement in manufacturing, a great demographics, a supportive geopolitical environment, etc. And capital markets should over long periods replicate that. But given the fact that India's inflation has moved lower compared to what we used to experience in 80s and 90s, I think to that extent, the nominal GDP growth should be lower despite higher real growth, and therefore commensurately our long-term return expectations from markets should also move lower compared to what we have experienced until 90s or early 2000s. So let me stop here, and I'm very happy to answer any questions or issues that are there, time permitting this. Thank you.
Thank you so much for a 360-degree view of the Indian capital market ecosystem, Prashantji. Questions are coming in thick and fast, and I have the task of picking and choosing a few for your consideration. This one I think you would like to take is, what are the factors that can derail the India story? You did speak vis-a-vis the capital markets, but India story on a larger landscape, what are the few factors that you think can actually derail that?
Actually, India's economic growth has been very persistent. If you look at last 4 decades, except the COVID year, every single year India has grown. Whether US interest rates were high or low, whether it was 9/11 or Lehman, even in the Lehman year, we grew 5.5%. So I think India's economic growth should sustain. What could put some pressure, however, on us is if energy prices spike up. India is a large importer of energy, and if oil prices spike up, then clearly it puts some pressure on the balance of payments. It could lead to some rupee depreciation, some higher inflation. So I think India is persistently a current account deficit country. Therefore, we are always vulnerable to a spike in energy prices, and that could slow us down. And any spike in energy prices could take 2-3 years for us to adjust to higher energy prices, and that could lead to some slower growth in the interim. But oil prices were $20 in early 2000s. By 2007-8, they were more than $100. So our software exports, they continue to rise. So over time, even higher energy prices we are able to absorb, but it takes some time.
a lot of investors are very confused when they do stock picking. What approach is more advisable for them? Should they look at a top-down approach or a bottom-up approach? What is your advice for our young investors?
See, I think, if you have to choose between the two, I think a bottom-up approach is clearly more rewarding and you are more in control. It's very hard to forecast macroeconomic indicators, but and it's also very hard to establish a linkage between the economic environment and the business environment at times. But I think a top-down approach should include a view of the industry. So good businesses, well-managed businesses that are part of attractive industries and are available at good valuations. I think this is a very effective way to invest, in my opinion.
What sectors that stand out in your opinion? Sectors for the next 5 years, 10 years that investors should look at?
See, the good thing about India is that most sectors in India continue to grow. So if you take a very long-term view of India, I think rather than focusing on sectors and stocks, one should focus on asset allocation. The Sensex itself is a diversified asset, and that is what is performing so well over time. But if I have to choose I think the banks in India appear to be well placed because credit growth is picking up and asset quality is in control, and the valuations are also in line with longer term. There is still some undervaluation is the energy space. This space has suffered a lot because of a number of issues, but I think markets are realizing that energy is a key to any country's well-being, and the incumbents also have good prospects for growth, and even conventional energy has many years of life left. So I think energy is one space which still continues to trade at fairly attractive levels, in my opinion. But again, coming back, I think we should keep in mind the most important thing, that India is a growing asset class, and therefore equities in India, diversified portfolio in India is a very rewarding long-term investment.
We do have at times people from the Ministry of Finance tune into our programs, and so taking advantage of this platform, if there were 2 or 3 reforms that Prashant Jain would like to see happen yesterday, what would those be?
Well, I think the pace of reforms in India over the last 10 years has really picked up, and you can see that in the sharp increase in FDI flows in India, in the cleanup of the banking system, the IBC, the GST, the RERA, the PSU demonetization, the Make in India. All these are, I think, very important programs, and we continue to move ahead. Recently, logistics has come into focus, but still, if I have to point out something, I think the power sector in India, I think we need to, the government is trying very hard. They are making one more attempt to improve that sector. I think power is a backbone of any economy, and we should endeavor to improve this sector so that reliable and competitive power is available to industry as well. And if that happens, I think it will aid further competitiveness to India's manufacturing.
With this, Shahji, we are out of time for our allocated slot. Thank you so much for demystifying so many aspects of the capital markets for our audience. Thank you very much.
Thank you, Alvi. Thank you, everyone. Thank you.
Thank you. Folks, next up, we have Shri Utpal Seth.
Good afternoon.
Good afternoon. Welcome, Utpalji. Just launching to introduce you to our esteemed audience. Couple of minutes of introduction. Utpalji is the CEO and senior partner, Rare Enterprises, founder and mentor of the Trust Group. He is a capital market veteran with over 25 years experience across various reputed Indian financial firms. He is currently the CEO and senior partner at Rare, which is a multi-billion-dollar proprietary asset management firm. His focus therein is on long-term investing in public and private markets, portfolio construction, and stock pricing. He engages with investee companies to enhance shareholder values by emphasizing sustainable value drivers. He is also the founder and mentor of Trust Group. Trust Group is the leading fixed income firm which has evolved into a full-service financial house. In Trust Group, his focus is on strategy, institutionalization, and team building. With these few words, once again, welcome Utpalji. And today, for the next 20 minutes, we are going to engage in a brief Q&A to demystify some things about the markets that our young audience, the demographic of our audience is largely youngsters, but I am told we also from time to time have people from the regulator and senior people from the Ministry of Finance. So to kickstart today's journey, what has been your investment approach, or what are the key components of your investment approach?
First of all, thank you, Alokji, and it is a pleasure and a privilege to be part of this August forum. Our investment approach has evolved over the years. I can say very clearly that the two most important components of our investment approach are megatrends and leadership. Megatrends are not fads, they are long-term secular trends. These are structural changes that are taking place. And to quote from Bhagavad Gita, it says that change is the only constant. This structural change is a key driver of value migration, and therefore participating with megatrends has been a great exercise. For example, in the late 80s, when motorcycles were launched for the first time, that segment created tremendous value. This was a new segment. Today, the megatrends that we are participating in could well be electric vehicles, it could be artificial intelligence, it could be digitalization. However, megatrends that have been going on for many years and still continue to go on are megatrends like consumption, financial deepening, urbanization, women empowerment, and so on. Leadership is the second factor which influences our investment approach. We find that only when we find a confluence of megatrends and leadership is when true value creation happens. This leadership is not just absolute leadership, but also leadership attributes. You could be the least cost player in a sector, or you could be the one with the best distribution, or you could be one with the highest market share, or you could be one with the best talent team, and so on. So there could be many attributes of leadership. If you find a confluence of those two, for example, if you could participate in the megatrend of the IT sector, and if you could participate in the leaders, which is either Infosys or TCS, you would have made a lot of money.
So there are many megatrends, but leadership is a topic that is seldom discussed. Could you help demystify that? And is it easy to spot one such opportunity?
Okay, so there are many dimensions to leadership. We think of leadership as, there could be clear leaders, near leaders, or emerging leaders. However, these three classifications are only applicable to companies which we feel fall into our investable universe. But if you go beyond our investable universe, then, and if you look at the full spectrum of all the companies listed, then the classification that we use is different. So there are companies which are maybe call them the poor cousins or the lallus, so to say, or you could have laggards, or then you could have leaders. But there is one category which is beyond leaders, and that is the elite category. We call that legends. So the important thing is, how does one classify companies and the management teams or the promoters across these different buckets, right? And I can tell you that over years, we made enough and more mistakes in mistakes of judgments. Yet, over years, we've kept on learning from our mistakes, and hopefully we feel that we'll make less mistakes in the future than in the past. The important thing is that today the leadership attributes make far greater difference to the terminal value of a stock than it used to maybe 20, 30 years ago when I started my investing career.
What is it that differentiates the leaders and the legends from the others?
That's a question which probably requires a far longer discussion. Nevertheless, I will make an attempt. Historically, one common characteristic that we found in leaders has been character and competence. Okay. However, character and competence is a necessary condition, but not a sufficient condition to be either leaders or legends. In addition to character and competence, I would say adaptability is a very important attribute. We are living in a dynamic world where business models or competitive intensity or competitive edge keeps changing and evolving. So if you do not have a management team which is adaptable, then that becomes a problem. In addition to character, competence, and adaptability, I would add resilience, a value creation mindset, and prudence to those factors. These few factors put together are important aspects of leadership attributes. However, besides these six, I can think of many more. For example, a leader who is not able to lead a good team is not a great leader. And that's a very necessary criteria. We find that people who are able to understand their customers or listen to their customers also make for good leaders. So there are many attributes to leadership. What is important is for you to have those attributes, to be able to identify those attributes and build your conviction in that leadership team with those leadership attributes.
If you could and identify a few megatrends in the making, they may not be matured megatrends as of now, but something that you've spotted that has caught your eye and could be a megatrend in the making, if you could help us with that.
Sure. See, it is not important to be the first to identify a megatrend. What is important is to be able to participate in that megatrend and then ride it to the fullest extent, right? So, for example, consumption has been a mega trend for many decades in India, but we've all discussed this before, that India is a $2,000 per capita country. When we go from $2,000 to $5,000 per capita, then the rise in discretionary consumption is going to be disproportionate as compared to any other category of consumption, right? Or financial deepening. Historically, India's financial sector has been growing at a pace faster than the pace of growth of nominal GDP. But we continue, we believe that that trend will continue for the next many decades. So one does not have to be in a hurry. One has to find and believe in the right mega trend and then find the right leadership to back.
Be only one leader, or there could be many leaders in a mega trend?
See, usually there are not many leaders. I draw an analogy between the animals of a jungle, where there are gorillas and there are monkeys. I mean, gorillas are very different. So you will always find that in the jungle, the gorillas are very few. Same way, it's not necessary that there is only one leader or one leadership attribute, but there are definitely very few leaders and very few leadership attributes in a sector.
Key attributes of value destruction in your experience? Because value creation everyone talks about, but it is these losses that really set an investor back.
True, true. So, besides the obvious value destroyers like wrong management intent or governance issues, we found that capital allocation and capital structure have been the greatest triggers for value destruction. If you see, most companies make a mistake on these two elements. What capital allocation does is it hurts future ROEs. What capital structure does is it hurts the future free cash flows. Between these two elements, one destroys a lot of value. So I would urge that apart from risk management and governance factors, one pays a lot of attention to capital allocation and capital structure as potential value destroyers.
Would you like to describe a couple of names of companies that have been value destroyers in your career that eclipsed an otherwise sterling run?
No, I'm sure. I mean, look, we've all made mistakes, and I don't think it would be fair to name companies necessarily, but I think each one of us has enough such examples in our respective portfolios. As Rakesh always used to teach us, making a mistake is not a crime, but repeating a mistake is definitely a crime.
In your experience in the Indian corporate sector, we've been plagued by governance issues from time to time. Where do we stand today vis-a-vis the rest of the world?
I would say that the transparency of Indian markets is probably amongst the best in the emerging markets globally, and is comparable to those in many more developed markets. I think SEBI has played a fantastic role for ensuring this, and which has furthered the growth and penetration of equity markets in India. It's a sea change from what it used to be maybe 30, 35 years ago, when you and I started our respective careers. I can tell you that today, as an investor, I do not feel any concern that we don't have the right regulatory environment or the right information disclosure requirements or the right transparency, etc. We will always have some or the other outlier, adverse outliers, but that happens everywhere in the world. I think India is on par with the best.
That gives a lot of comfort to hear it from you, someone who interacts with corporate managements day in and day out. What is the biggest change that you appreciated during your investing career spanning almost 3.5 decades?
I would say from the very beginning, there was this one framework that appealed a lot to me, which said that I should have a variant perception. And this was a term used by one of the hedge fund managers in a book called The Money Masters or The New Money Masters by John Train. And I have extended that to imply not just differentiated perception, but superior insights. And superior insights is what gives you the deep conviction required to have the vision to see, the courage to buy, and the patience to hold on to your long-term terminal value winners. Over the years, the big change that I feel has contributed to this process of superior insight has been that we moved from an age of tangibles to an age of intangibles. Maybe 30, 35 years ago, intangibles contributed to 10 to 15% of the value of a company. I believe today intangibles contribute 85 to 90% of the value of companies. And therefore, understanding those intangibles has become a deep imperative. Intangibles are more difficult to understand than tangibles, but once one understands intangibles, one is able to appreciate them more and appreciate the power of these intangibles over the years to help one compound one's investments.
Can intangibles lose their value very rapidly?
Yes and no. We all know that Rome was not built in a day, but we all also know that Hiroshima and Nagasaki were destroyed in a day.
Yes.
So it takes a long time to build intangibles, and it is very easy to lose intangibles. But one thing I would like to highlight, and that is that intangibles, if a company has worked towards building very solid foundations for those intangibles, then even if things go wrong, their resilience and the resilience of the management team and their ability to come back are all part of those intangibles which enhance value for investors.
One thing I can't resist asking you, Utpalji, is that behind this very calm and almost soothing exterior is a very razor-sharp mind that does analysis. What makes Utpal Seth? I mean, how can you keep calm in such volatile markets? That slight smile, and how do you manage it?
I feel that the state of mind of any investor has a huge contribution in the long-term success or otherwise of that investor. Okay, so I try and ensure that my state of mind is always protected. I've had the good fortune of having wonderful teachers and mentors over the years, and I've learned from each one of them. I will just add to that to say that, look, investing is an act of wisdom and not an act of smartness. Therefore, one has to keep pursuing wisdom to ensure that one is a better investor. Being smart is overrated and wisdom is underrated. If I may quote, I think it's probably T. Boone Pickens who said that most people are nowadays trying to benefit from the advantages of artificial intelligence. He says, I prefer to benefit from the natural stupidity of others. So I would say that it's not important to be smart. It's important to pursue wisdom.
And on that note, we have completely run out of time. Thank you so much, Utpalji, for throwing light on so many issues, right from megatrends to leadership. And I think our young investors will have immensely benefit, and looking forward to having more such conversations with you in the future. Thank you very much.
Thank you very much. Good day.
Friends, we now come to the last segment of our section right now. And with us, we have Mr. Deven Sangoi. A brief introduction about Devenji. Welcome, Devenji.
Welcome.
Deven Sangoi is a chief senior manager at Abacus. He has a wide experience of over 22 years on the asset management side, out of which 10 years have been in the mutual fund space and 12 years in the insurance industry. His previous assignment was that of Chief Investment Officer of Canara HSBC, OBC Life, managing both equity and fixed income with a corpus of around $4 billion US. Previously, he worked with many reputed organizations in financial services space, which include leading names like Aditya Birla Sun Life, Aditya Birla Sun Life Asset Management, ICICI Prudential Asset Management, etc., etc. He is graduated in electronics engineering from Mumbai University and holds a postgraduate degree in finance from Newport University. A very warm welcome to you, Deven Bhai, and over to you to shed light on various facets of the capital market, your life and times here.
Thank you, sir. Thanks for giving us an opportunity at Abacus and Deven Sangoi personally. I would briefly take you through the history of my life. And actually, I really thank you that I think this session has given me an introspection of what I have been through. So I started my career as an analyst in a small broking house called Alchemy. And I was fortunate that one of the partners of Alchemy was Mr. Rakesh Jhunjhunwala. And during my formative years of doing research, I got a lot of mentoring from him, which allowed me to, shape as a better investor and help me found my way of looking at investment. At the same time, during the same tenure, Mr. Late Chandrakant Sampath was known to be a Warren Buffett and mainly investing in MNC high quality company. So both these gentlemen have really helped me, in my founding years of understanding equity and investment. In 2000, I got the opportunity to work for Birla Sun Life Mutual Fund. And I think that time the mutual fund industry was quite in a nascent stage. The opportunity was given by my former boss and another mentor, Bharat Shah. And during that time, again, under Mr. Shah, I learned significantly about how to invest in business, how to understand the business and various balance sheet and completely number driven. So though it was a bottom up growth style of investing, but all the mentors gave me a different kind of training to look everything in a perspective. In 2003, I was given opportunity by Birla Sun Life Mutual Fund to become a fund manager. But this time it was a completely new mandate. This was the first dividend yield based fund in the form of a mutual fund. Dividend yield was a very popular out as a individual investor, but nobody launched a scheme, and which was completely stat and value driven, which gave me a lot of understanding of how to look at value, how to invest in value, and how important is to pay right price for every investment you do. So it was a completely different experience, in a sense that I've been all throughout a growth investor, and I got really surprised by what value can do in investment thesis and how it can change. In 2005, I joined ICICI Prudential AMC as a senior fund manager, and then became a head of equity, overall managing close to 16 to 18 funds with different mandates, from large cap, small cap, services sector. And that was an era of 2008 where momentum investing was the name of the day. And post that, you have seen a very pre and post Lemon were also very, very important ways to look at investment and what to do, what not to do. So in an institutional setup to go through such a huge volatility on the market, and it also gave me an insight that during that time, how macros, global macros and macros are important investment tools. And some of these learnings have, helped me to, go and shape to become a better investor. It's always a learning. You need to learn new skills. And I started moving towards my journey in 2009 for a large mandate, less volatility. And that's how I shifted more towards, insurance. So I took a mandate to become CIO equity and Birla Sun Life insurance. Since my background was also there in research, I started extensive looking for the credit and the credit exposure we take. Besides that, there was a prop mandate to generate positive returns for shareholder from the insurance company point of view, and investing in AIF of unlisted companies. So there are various opportunities given to me, and my journey to learn different investment skills and different kind of asset grew. And I actually shaped me much, much better as investor. So when you look at investing, it's not, it's an art, not a science. And as you learn more and more different facts like macros, fundamental, currencies, and all these inputs help you to become, the different kind of signals come from that, and you process that to become an investor, and investing becomes an art. So that's my overall journey as an investor. On the market, what we have seen is an unprecedented kind of a bull run came out of the large quantitative easing done by central banks to prop up growth. And this has been growing since 2008, but it became much more massive during COVID. So we had seen one of the best 2 years in equity investing, and post that current year has started with the volatility, and then few events like Russia-Ukraine war have really started making an deflationary force getting into an inflationary force. And suddenly inflation became an issue and a top priority for the central banks. And after a length of years of easy monetary policy, first time we've seen such an aggressive quantitative tightening. And now, because of this tightening, there are fears that larger economies like US, Europe may fall into a stagflation. Overall global economic growth will slow down. And because of this tightening, the demand destruction will happen. And overall, the situation from a very big exuberance in the start of the year to become a very volatile and worrying. And India during that time has done significantly better till March of this year. And post that, May and June has been very challenging. And again, July onwards, Indian equity market has done much, much better. And there has been a sharp rotation also in the sectors. We've seen IT, pharma, chemicals been underperforming, and suddenly banks and domestic related sectors have done very well. Going forward, if I see, I think we will continue to be one of the growth market. Indian equity market will deliver a double-digit kind of a return. And it won't be a linear, but we have done almost 13-14% compounded over a longer period of time, and we'll continue to do that. For next 2 years, we expect corporate earnings to grow in terms of 15 to 16%, and we will have similar kind of market return. Macroeconomics wise, India continues to stand out in global overall fiscal side, current account side, and even in the forex reserve side. We have much more cushion up till now. And the growth also has become diverse. I think India actually have gone through a lot of, I would say, reforms over a period of time, starting from Demon. Post-Demon, we had ILFS crisis, NBFC, and GST, and then COVID. So I think there are a lot of reforms which have happened, and Indian corporate sector during that time have gone through one of the worst periods, or I would say it has been the best, and the fittest have survived. So the corporate sectors is looking pretty good. Balance sheet are in very good shape. Banking sector has gone through a big NPA cycle and mode of recovery. So overall growth is driven by manufacturing revival, capex, export, and domestic consumption. So overall, India looks to be very fairly placed. India continues to look very better. Even in the currency front, we have seen Indian currency has been one of the best performing. And large part of the fears of global slowdown and an event are factored in. So we feel that any kind of crisis or correction in global market, if market goes down, it will be a brilliant opportunity to enter in Indian market. And overall, the macro, micro both look excellent. That covers my presentation.
We have a lot of questions coming in thick and fast, Deveji, and I will address a few because we still have some time allotted to us. Foreign fund flows still an area of concern. Our markets are doing so exceedingly well, but we are actually seeing some kind of outflow, and foreign funds are not coming in. So how much of a concern is that? And
I think a lot of attention is being given to foreign funds, but people have forgotten the strength of the domestic flows. And we had a similar kind of selling happened in lemon time, which was almost $40 to $45 billion in a very short period of time. The market collapsed by almost 40% during the lemon. And we had a similar correction selling done this time by the foreigners. And Indian mutual fund industry and Indian investors have absorbed. So we were down 15%, but we are just 5% away from our peak. So I think there is a lot has changed. India is no longer a smaller economy. We are a $3 trillion economy. And if I be very, very conservative in the saving rate of 25% adjusted for inflation, our saving is $750 billion a year. A 10% flow is 75 billion. So we have not reached there, but what I'm trying to say, the potential of equity as asset class is very big. And if you see the per capita, highest equity ownership was in 1992. We have not even reached there. So I think domestic flows are very strong. I think we have seen the faith of domestic investor in our stock market after a long time, and large part of it, it is coming out of the SIP. So foreigners will come, sell, there will be volatility, but I think Indian flows are the one to be watched for. And as long as they continue to be strong, which I believe they will remain strong and they will grow even more than what we have seen, we are reasonably safe.
There is one accusation being laid at the doors of RBI, that RBI is defending the rupee at the cost of 100 billion depletion of forex reserve. How do you look at it?
So if you think the RBI is defending, I think first of all, if you look at the best performing currency, I think India is on second or third. It's never ever happened that today a pound, a Japanese yen has depreciated more than India. Second is that if you look at our exports are also, though our imports are growing very fast because of the economic recovery, our exports have to be sustained and they have to be maintained competitively. So today, if you see, I haven't seen in last decade that Indian rupee depreciation is lower than the Chinese yuan. Chinese yuan is, and again, other competitive currency, we still are more stronger. So the rupee depreciation is also part of the thing that we have to help our exports sustain momentum and they have to be competitive. In the current scenario, letting go of rupee by 5-6%, I don't think so. It's a bad move. And I feel it's a right move to sustain our export and keep our competitiveness. There is no way there is run on rupee. We are not in that situation. We still have $500 billion of forex reserves.
Global headwinds somehow seem to be against us. Although there is traction economically and the tailwinds seem to be favorable, how will we weather these global headwinds? Because
so if you look at the couple of factors, I think all across the time we've been worried, and especially India has been talked about the twin deficit, a fiscal and current. Fiscal, we have managed despite of COVID, we are in one of the best shape. And I think, again, we are on FRBM that every year we will continue to, reduce the fiscal deficit. Second, there have been a lot of reforms done like GST, which are improving tax to GDP. And if you see the GDP pre-COVID and post-COVID, I think GST collection is almost up 20% for the similar kind of GDP. So it's improving tax compliance. So our revenues are much more, I would say, stickier, better, and much more compliance is coming into play. On the current account, oil is the biggest worry, but you also have to see that capital account, which was primarily a capital flows, which was short term, a large inflow of FII and large outflow of FII used to cause problem on the current account front. But today, we have higher FDI investment than the portfolio investment. So our kind of capital flows which are coming, which are much more longer duration, and we have seen almost 82+ billion kind of FDI flows for last 2 years. So this portfolio flows, which have been very volatile, coming and going with risk on and risk off, is been converted by long-term FDI flows, which are not volatile. So I think that gives you another question. And today, India is the fastest growing, one of the best demographics. And there are a lot of people who want to do business with India from an FTA to have access to our market. So we are in a completely different position than what we are. And post-COVID, I think there are a lot of events which have happened, which are favoring India against China. So all of them are very positive for us.
Yeah. we are running out of time, but I can't resist but ask this one question, and that is, what are the couple of reforms you'd like to see Government of India to do that are badly needed?
I don't think so. I think they've done a lot. I think except for the one which is on the divestment side. It's been a lingering one, but otherwise, most of the thing have been done. And silently, they've been doing a lot of things which are either ease of doing business, improving compliance. A lot of things have happened. So I don't have too much of ask. From the capital market side, one divestment will show the power that it is also reforms to, there's a lot of assets, hidden assets sitting. And that's also one of the cushion which a lot of governments don't have, that we have, that there are jewels sitting, and if needed to, get the fiscal prudence, we can sell them and raise the wind.
We are completely out of time and we seem to have overshot our designated time, but thank you so much, Devin Bhai, and it's been a pleasure talking to you, but we will extract a promise before you go that we will hope you will make yourself available for more sessions like this in the future, and we will get back to you.
I'll be glad. Thanks for giving the opportunity. Bye.
Thank you so much. And with this, I hand over the baton to Parth Niyati, who's waiting to take on the next session. Is Parth connected yet?
He's connecting.
He's connecting. Okay. So while Parth is connecting, not to leave our viewers in a limbo, since our chairman Lalitji Mundra is here, Lalitji, what do you make of the session so far?
Namaste Alokji, namaste all our viewers. So many interesting sessions, Alokji, you have hosted, and I was, excitingly watching you thoroughly, regularly throughout all the 3 days. Lot of new learnings, which I'm likely to share towards the end of the session. So now the Parth is also in.
So, we were, just in case if Parth is wondering if I have taken his job, I haven't. I was just using our chairman Lalitji as a filler while you were logging on. So I now hand over the baton to you, Parth. Over to you. And I'm Alok Churiwala and I'm out of here. Thank you very much.
Thank you, Alokji. I think nobody can do this job better than you. So in the past 3 days, we all have been really fortunate to hear straight from the galacticos of the Indian stock and global stock markets ecosystem. So we have remained captivated with such refreshing knowledge sessions, of which I will give a brief recap at the end of this closing session. Now, to give away their observations on a successful India Investor Show 2022, I welcome Ms. Catherine Edmondson and Mr. Lalit Mundra. I first invite Ms. Catherine Edmondson, Executive Director of International Forum for Investor Education, IFIE, for her observations and takeaways.
Catherine, you're on mute.
Catherine has joined us via a phone bridge. I think she is on mute.
Can you hear me now? I'm sorry.
Yes.
It seems like the bridge was changing. It kept switching on and off. Can you hear me now?
Yes, Catherine. Loud and clear.
I apologize for that. Thank you. Thank you for, again, for gathering together for this 3rd annual India Investor Show, credited and organized under the auspices of BBF and IFIE, again under the auspices of SEBI's leadership, in honor of IOSCO's World Investor Week 2022. I once again thank especially BBF and its leaders, members, staff, and colleagues for their leadership and commitment and tireless efforts, including to support the work of IFIE and IOSCO. As we bring this event to a close, I remind you have access to resources and information from this event, including through YouTube channels. Some thoughts on lessons learned, ways to go forward suggested by our time together. Overall, it's always and never more so now to ask in each of and all of our contexts, do these 3 days together suggest our approaches and concerns are critical and the appropriate ones towards strengthening the individual investor's financial resilience in context of his or her life, goals, family, community, present, and future, and the goals of accountability, transparency, inclusiveness, equity in the financial markets? I think the answer is yes. Strengthening financial capability, investor education, and protection qualities have critical roles to play in increasing investor financial resilience and confidence to participate in financial markets, obviously on an informed basis. So 3 specific thoughts. First, I believe these last 3 days have reinforced the fact that we will continue to have to, as a community, focus on risk issues and assessment related to retail investors in our markets, including because rapidly evolving complex environments with new dynamics create opportunities, but also increase some risks. As well, some investors new to the markets, as well as experienced investors, have changed how they assess and ask on risks in making decisions given the last 2.5 years. Number 2, increases in digitalization of markets and in investor participation in them, as well as in social media dynamics, are changing how financial products and services are distributed and marketed, but also how retail investors act and interact with the financial markets and financial products and services. This has a wide range of implications for individual investors and the financial market ecosystem they interact with, from online security and online investing to what and how individuals are influenced, the information filters and context they use, and who they trust. Number 3, in the opening session, I said one of the goals of this yearly event for BBF and IFIE is to extend the ideas of IOSCO's World Investor Week to the other 51 weeks of the year. I challenged you to use this time to learn, think about your parts in this collective effort to strengthen individual investors and this context and field, what your next steps might be, areas to build on, bridge, partner, revise, repair, etc. Wherever you're focused, together, we're looking at how individuals become more aware, build knowledge and how-to skills, and then act in context of learning who to trust and what sources, what to do, and how to strengthen themselves, their families, communities, and all in the context of COVID-related dynamics, increases in complexity, uncertainty, and change. For new investor groups such as young people and or entrepreneurs or women, but also experienced investors. All of us have been impacted and or are trying to understand how to act in context of the changes in markets or new areas of investing, such as the emerging dynamics, products, and services of sustainable finance. What is happening now and what we do together, this group and others like us, will impact a generation of investors all over the world. We know that influences on finances affect people's generational assessments of how they will manage money and what they will do. We've seen it repeatedly, and we're already seeing it in the context of what we're learning from the impact of COVID, for example. So speaking from my experience in this evolving field over time globally, I think we have heard and seen in these last 3 days evidence that we have opportunities. In the language of the SEBI chair, opportunities that are also quote unquote free. So 2 examples. 1, as individual investing accounts increase and individuals desire to be involved, to pay attention and understanding the necessity of institutional contexts, we will see that individuals may need to understand more about direct impact and relevance of institutional market frames for their futures, whether, for example, in how pension schemes work and what they invest in and what individuals are expected to approve or not approve or react or act, and or insurance products and services. Just two examples. This is an opportunity we all have to understand how individuals interact, what information they need, and how they make decisions with institutional market structures, even if indirectly. I know from work, as I'm sure you all do, that individuals are paying attention in this area and they're going to need help, but we're also going to learn a lot about what kinds of assistance, information, et cetera, supports are going to be needed to make their interactions across the retail markets and institutional markets clearer and more effective. Second, we have the opportunity to understand more about individuals new to the markets or new to a particular type of investing, such as sustainable in all its emerging dimensions, need to have to be informed to make active and smart decisions. What I'm seeing in this area already, including in different generational cohorts, is that individuals seem, at least in some areas, to want different types of information to learn and to make decisions, different across cohorts, but also different in that they might be being provided with information that they don't actually use and that they want other information that is not being provided. We can learn a lot right now about what individuals new to the markets or new to a particular type of investing need to participate in informed ways, and or what influences new or additional decision making, risk assessment, et cetera. These are all huge opportunities to strengthen our markets and help strengthen financial resiliency in a challenging, transformational, and dynamic period. I cannot thank all of you enough. I look forward to being with you in person soon, to contributing and working with partnerships and collaborations and conferences with BBF, SEBI, and IOSCO. And I thank you again for your time and attention.
Thanks, Catherine, for your observations. And I'm sure we all of us are going to work together to keep simplifying investing for the current investors as well as the next generations to come. I now invite Mr. Lalit Mundra, Chairman, BSE Brokers Forum, to share his thoughts and takeaways.
Thank you, Parth. Good evening, ladies and gentlemen. At the outset, thank you all for joining the third edition of BBF-IFIE World Investor Week celebrations, India Investor Show 2022, under the aegis of our regulator SEBI, over a period of last 3 days, beginning from October 11 to October 13. This marks BBF and IFIE's third year of World Investor Week, a global effort promoted by the International Organization of Securities Commissions, IOSCO, and supported in India by the Securities and Exchange Board of India, SEBI, bringing together regulators, exchanges, associations, and market interested institutions to raise awareness about the importance of investor education and protection. The questions like planning for life's unexpected challenges, being mindful of economic conditions, and creating an investment portfolio for the long term help investors set strong foundation to build their financial future. This year's WIW, BBF, and IFIE hosted outreach event highlighted the importance of establishing an emergency fund, avoiding high interest debt, conducting research on investment opportunities, understanding the risk of investing, portfolio diversification, fraud prevention, and many more. In the series of these 3 days, BBF India Investor Show 2022 with a tagline, "I love stock markets," got together policymakers, industry stalwarts, and investors on the same platform to discuss, deliberate, and comprehend on the future course of financial markets. We are glad to share that over 2,000 plus people attended our event in the span of these 3 days. We indeed hope that the perspectives shared by our dignitaries were interesting and informative, and their thoughts would have made some real traction within the audience that will translate into future investment philosophy. Investor education and awareness is core to our mission at Bombay Stock Exchange Brokers Forum, BBF, and we are honored to serve at national level, conducting series of programs for investors and young adults. On that note, our sincere gratitude to our regulators, exchanges, MIIs, dignitaries, and speakers. Thank you once again for your kind support and valuable time towards our event. I'm sure that the cooperation with all of you will continue in future. In conclusion, I would like to quote the wisdom of one of our great investors, Mr. Shelby M.C. Davis. It says, invest for the long haul. Invest for the long haul. Don't get too greedy and don't get too scared. So be patient and think long term. Thank you so much.
Thanks, Lalitji, for these words of wisdom. And I'm sure all the viewers will eagerly await the next edition of BBF-IFIE India Investor Show next year. So as I was saying, in the past 3 days, we have witnessed the galacticos of the stock market ecosystem enlighten our investors. I'll quickly summarize some of the takeaways for our investor friends. From the fundamental and economic perspective, global uncertainty has increased manifold. Families in the first world are increasingly finding it difficult to even pay their utility bills. Central banks are challenged with inflation. And in this situation, India appears like an oasis in a desert. Keeping aside the global impact, we are the fastest growing economy in the world and are better placed than any other country. Our companies are fundamentally strong with increasing earnings and better corporate governance. Despite a trade deficit and a weak rupee, most of the speakers showed confidence in the Indian growth story and encouraged long-term investment in the mutual funds and stocks. Some speakers mentioned that the traction from foreign investors and businesses has increased in Indian markets, and Indian investors and domestic institutions are also driving a lot of demand for high quality stocks. The Indian markets have remained resilient. Any positive turning of events globally could pull the markets up. So instead of thinking about the right time to invest or getting worried about short-term corrections, we should stress more on how long we can stay invested. The speakers highlighted the importance of investor education and how one should exercise due diligence while investing instead of blindly following anyone's advice or tips. They also cautioned investors to be careful of cyber frauds. Investors should also understand their own risk appetite, net worth, and financial plan and look at diversifying their portfolio. A regulator, exchanges, depositories, clearing corporations, brokers, and all other market participants are upscaling their technology infrastructure to support high volumes, simplify investing, prevent fraud, and educate the investors. The last 2 years have witnessed crores of new Indian investors coming in the markets. In fact, we have surpassed 10 crore demat accounts recently in August. Our Gen Z, millennials, and women investors are driving the equity cult. As investing is becoming more and more fashionable, it remains imperative for the investors to understand any risky or unregulated markets before getting into them. It's best to stay away from unregulated schemes that offer guaranteed returns. Another key theme to be noted by all young investors is that financial planning is of utmost importance before they start their habit of saving and investing. And retirement planning, health, and term insurance should also be looked at with seriousness early on in life. And last but not the least, in the IFIE India Investor Show, the BSE Broker Forum launched the much needed compliance boost software, which would greatly help brokers to stay on top of their compliance checklists and would help them through regulatory changes. This was lauded by everyone, right from dignitaries, from SEBI to MIIs. With this, I would like to hand over this session to Dr. Aditya Srinivas from the BSE Brokers Forum to conclude the event.
Thank you, Parth, very much for giving me this opportunity. Thank you very much. See, basically, friends, these 3 days were quite power-packed, and this was the 3rd edition of India Investor Show during the World Investor Week, which is observed globally. We really, from the heart, thank the Securities and Exchange Board of India, SEBI, for providing us this. Under their leadership, we are able to do all these things, plus BSE Investor Protection Fund. Apart from these, friends, these 3 days enlightened the power of knowledge. See, the more an investor is aware, the more he is protected. The more knowledgeable he is, the more well financial planning he can do. the various sessions, as basically outlined by Parth, clearly highlight the importance that various market participants and all stakeholders are trying to put in to protect the investors. Right from day one, when all the MIIs, that is the market infrastructure institutions, they provided their insights how to develop the overall capital market ecosystem and why they are playing such an important role to ensure that investor protection is the key, right from the regulators to basically the capital market intermediaries. Today, everyone is focused upon one theme, that let us help the investor to be self-sufficient, self-reliant. Not only this, but other sessions were equally important, where the focus was on the various kinds of risk that investors should know, the known risk and the unknown risk, which was discussed by various heads of investor protection funds, how investors should carefully design their strategy, how they should be careful while investing and selecting fundamentally sound companies and staying away from Ponzi schemes. Apart from this, the Vision 2025 that enhances the roadmap towards Indian economy. Today, Indian economy is considered to be one of the fastest growing economy among global headwinds, which is marked by various wars, rising inflation, rising interest rates, and central banks battling on one side inflationary pressure and on other side ensuring that the GDP grows. In this scenario, every speaker assured that basically India is the silver lining, and there is no doubt in that. Especially when we have 70% of our population less than 35 years of age, and the domestic consumption theme being the backbone of our economy, I am sure that in coming times, we will get more and more investors into the market. It should be highlighted that in last 2 years during the pandemic, which had stopped the whole world economy, even then we had a very vibrant capital market and large number of new millennials joined the market. That shows their confidence in Indian economy. Not only this, but even the monthly flows in the form of SIP has crossed 10,000 crore rupees mark on a monthly basis. That again highlights the confidence of a retail Indian investor. Women, which account for 49% of the population, have also shown a lot of interest in investing and becoming financially independent. And that was one of the entire power-packed sessions from women speakers that highlighted the importance of financial planning and becoming financially independent. Last but not the least, the legends give their insights regarding what mistakes should be avoided while you select a stock, what should be your long-term perspective, and even they acknowledge the fact that ultimately India is the future of the world, and sooner we will become not only a $5 trillion economy, but in next 25 years we could be a $30 trillion economy, and India could show the world the road ahead. Finally, friends, the whole objective of this World Investor Week IFIE BBF event is basically to give huge knowledge to large number of investors, potential investors, so that a well-informed investor is a well-protected investor. I would like to personally thank all those people who have kept their day in, day out efforts to make this event a highly successful. Thank all the regulators, MIIs, and each and every speaker participant for contributing in this event. Thank you, Parth, once again very much for basically giving me this opportunity. Thank you, everyone.
So with this, we would close the session. Thank you, Dr. Aditya, and thank you, Lalit ji.
Thank you.
Thank you.